Welcome to another episode of Phillip Trading Podcast. So my name is William here, and our speaker today is Miss Me, which is our marketing and dealing executive at Phillip Capital. How are you today, Me?
Hi, I'm good. How about you, William?
Yeah, I'm very good as well. Very good to see you again today. Okay, so today we will talk about gold. Okay, so gold is very famous for its inflation hedge. So with the entire market is currently anticipate a recession in year 2023. Okay, coupled with the very ultra high interest rate, can gold continue to go higher? Okay, so before we talk about the price movement of gold in 2023, can you please explain or share with us what are the key fundamentals that will actually move the gold prices?
Okay, so thank you, William. So the first will be the monetary policy. So reason being is that the interest rates has a big influence on gold prices due to a factor known as opportunity cost. So the opportunity cost is actually the idea of giving out a near guaranteed gain in one investment for the potential of a greater gain in another. So if the Federal Open Market Committee, short-term known as FOMC, take a stance that in price rate could rise in the near future, the gold price will tend to react poorly, so the opportunity cost of foregoing interest-bearing assets increase. So, however, if the FOMC implies that the rates are planning to hold steady, gold prices will tend to rise since the opportunity cost of foregoing interest-based assets remain low. So the second will be the supply and demand. So gold prices, like any other good and service, are subject to the laws of supply and demand. So for the law of demand will be the higher the price, the lower the quantity demanded. While for the law of supply will be the higher the price, the higher the quantity supplied. Equilibrium, which is where demand and supply interact, then determines the market price. This is one of the most important determinants of gold prices, since the demand and supply forces produce market shifts that influence gold market prices. If demand for gold increase, gold price will increase. Gold price will also surely decline if it is oversupplied. So let's move on to the third determinant, which is the inflation. Gold prices tend to increase during times of high inflation as investors will use them as a safe haven asset to ride out uncertain times because gold tends to increase in the value due to the buying power of the dollar declines. So the last will be the movement of currency, which is very specifically the US dollar. Since the price of gold is dollar denominated, is another strong influencer. A falling US dollar has a tendency to push gold prices higher because other currency and commodities around the world increase in the value when the dollar falls. Conversely, a strengthening US dollar often comes about because of a growing US economy. It is also pushed down the gold prices since the gold and the US dollar have an inverse relationship.
Okay. So in short, I think the few key factors that you just talked about is definitely the Federal Reserve monetary policy, the inflation, and also the US dollar. Okay, these three items, if traders are trading the gold, might need to pay very close attention to the three items that we just covered. Okay, next question for you, Lee, is that what are the impacts of, as I mentioned just now, we are currently in that ultra high interest rate era. So what are the impact of this ultra high interest rate on gold prices?
Okay, so gold actually start to lose its glitter since central banks started hiking rates. Increased interest rate adversely affect gold as it is an interest-free investment. A strong US greenback hovering at a two-decade high also weighed down the sentiment of the gold. So the recent increase in interest rate and high inflation skyrocketed the US currency. The US dollar has started appreciating against other currencies since the mid of 2021, but the most rapid rate of the increase happened since the Russian invasion over Ukraine. The dollar denominated gold becomes cheaper when the US dollar strengthens. Yeah.
Okay. So another question is gold price sustainable in the current ultra high interest rate era? Do you think it's sustainable? Because gold price is above or is 1,008, which is still very high. So is it sustainable?
Okay, so while the Federal Reserve continues to take a firm stance on inflation, economists actually note that the central bank is closer to the end of its tightening cycle, which could be good for gold. So actually, the Bank of America also looks for the Federal Reserve to end its tightening cycle in the next year, March, and sees the first rate cut by the end of 2023. So in this kind of environment, gold prices have a path to move to $2,000 an ounce. However, in the short term, gold prices could struggle because investors have been adjusted to a new terminal rate high above 5%. As in the last monetary policy meeting for 2022, the Federal Reserve forecast that the Fed funds rate peaking about 5% in 2023.
Okay. So sounds like you are quite bullish about gold. You think 2023 gold might go up to 2,000 again. There's another 200 bucks to ready. Okay. So okay, just now we talk about key fundamentals. So now we talk about the data. Just now is the fundamental, now is the data. So for our traders that are trading gold, what are the key data that they need to look at every week or every month in order for us to trade the direction of the gold?
Okay, well, I would say that it would be the economic data, such as the jobs reports, wage data, manufacturing data, and also broader based data such as GDP growth, influence the Federal Reserve monetary policy decision, which can in turn affect the gold prices. So actually, a stronger U.S. economy, as you can see that for lower unemployment, job growth, manufacturing expansion, and also the GDP growth in excess of 2% has a tendency to push the gold prices lower. So strong economic growth implies that the Fed could make a move to tighten monetary policy, which will impact the opportunity cost that we have been discussed and as mentioned above. So on the flip side, weaker jobs growth, rising unemployment, weakening manufacturing data, and also poor GDP growth can create a dovish Fed scenario on interest rates and also increase the gold prices. Yeah, these are the data that you could look at when you trade for the gold.
Okay, so just one last question for you, which is what are the potential price direction for gold in the next few weeks and also for the next year, 2023? What is the direction of the gold?
Okay, so although the Federal Reserve is drawing the pace of rate hikes, it will continue to tighten its monetary policy in the new year, so limiting the investor to be interested in gold. So it is unlikely that Federal Reserve will be able to get inflation back down to its 2% target. And this higher inflation environment will be a long-term positive for gold as investors look to protect their purchasing power. Besides that, market analysts also stated that other than the monetary tightening by the central banks, demand in the domestic markets will also guide gold price in the coming year. So factors like the mild recession that the investor have been wondering for, also the continued geopolitical tension, receding the inflation and improvement in demand with the reopening of the China would as a tailwind to boost the gold prices into 2023.
Okay. Thanks for your sharing today, Mini. So once again, for people that are listening to this podcast, if you are interested to find out how to trade the gold futures, feel free to drop us a message via our Facebook and one of our representatives will contact you soon as possible. Okay, and thank you, and probably I will see you again next time, me.
Thank you. Bye.
Bye bye.